Did you know that you can run your business through a business trust and get 100% asset protection and significantly reduce your taxes much better than you can with an LLC or an S corp? But before I go into that, I want to show you or tell you that I am not a licensed tax or legal advisor. I don't give tax, legal, or accounting advice. This information has been prepared for informational purposes only and is not intended to provide and should not be relied upon for tax, legal, or accounting advice. You should consult your own tax, legal, and accounting advisors before engaging in any transaction. So, my name is Dohn Thornton. I'm a 21-year real estate investor. I'm my 22nd year right now. I am the best damn short sale investor in the country. I flipped well over 3,500 short sales in my day. And my company HB Funding has an A plus rating with the Better Business Bureau since 2004, and I am an owner of this trust. So, what I'm going to cover today is why your current business model is obsolete. I'm going to tell you what a business trust is and how it works, and show you a new way of maximizing your profit and limiting your liability exposure. So, look, for most people, their current model is with either an LLC or an S Corp. And it could be single member, it could be multi member. A lot of take a salary, a smaller salary, and then you add on K1 distributions. If you have an S corp, which I've had for 21 years, it's a single member. You run everything through your company, and then whatever's left over flows down to you and your individual tax return. And most of us do pay ourselves a salary. Now, the disadvantages with LLCs. Well, for one thing, taxes. Besides deductions, there's not really any way to reduce your taxes. And if it is, I mean, there's some convoluted things out there that you can try, but you end up making, you save money, some money on taxes, but then you're going to be paying so much more to the financial advisor that you're paying to set all this stuff up. So there's not much in the way of tax reduction. Asset protection. People think, well, I'm going to put my stuff in a LLC, so that way, protect my assets from other things. And what happens is that you have, like in real estate, you might have, I don't know, 15 uh, rental properties, and they're all in different LLCs. Well, okay, yeah, theoretically you can't get to it, but any lawyer worth his salt can pierce the corporate veil. They're not that hard to pierce. And remember, every LLC is a separate tax return, paying your CPA or your accountant to do all that stuff. So it gets pricey. And listen, the IRS, remember, they're bringing in 80,000 new agents, and what we hear is they're going to be looking a lot at LLCs, especially pass through LLCs. So that's a disadvantage. And S corps, I mean, it's kind of the same thing. Besides deductions, there's not much way to reduce the taxes, not like what we have. And the asset protection is fine until they decide to go after you, and the corporate veil is not that hard to pierce. And the same thing, right? The IRS is looking for ways to increase revenue, and revenue means taking money from your pocket. So what we're talking about is going to be different. But as I described, I mean, if you think about it, the corporate system is really obsolete. And when I go in and talk to you about how this works with a business trust and your beneficial spendthrift trust, you're going to see exactly what I mean by why this existing system is obsolete. It fails us mostly in these ways. There is not enough tax reduction. Everybody uses the same tools, but it all bottom line is, and I hear this all the time when people come to me and saying, "Look, I'm trying this and this and this, but at the end of the day, I'm still paying too much in taxes." And if you just Google, you know, uh, wins for personal injury lawyers, they're out there getting multi-million dollar judgments against companies. If their existing system worked, then why does that keep happening? Because it doesn't work well. I mean, as long as you stay out of someone's spotlight, I guess you're okay. But boy, I tell you what, the spotlight gets on you, they will go after you like stink on poo, as they say. And of course, it's expensive accounting consulting. You want to do more things. They have these convoluted, complicated things that cost money, right? So these are really the failures that the existing consulting licensed attorney, CPA, think tanks. That's what they're offering you. Okay, so let's talk about a better solution. Let's talk about a business trust. So, what is a business trust? It is a non-grantor, irrevocable, complex, discretionary spendthrift trust. What's nice about it is that you can run multiple projects through it and multiple income streams. You have unlimited bank accounts, and it's all under the umbrella of one tax return. Okay. And I'm going to get into a little bit deeper about how this works, but I have three income streams in my business. I run them all through a business trust, and it's so much better than it was before. Okay, so what is a beneficial trust? We, sometimes call it a spendthrift trust. Well, it's also a non-grantor, irrevocable, complex, discretionary spendthrift trust. All passive income that comes into it is non-taxable. Capital gains taxes are excluded or eliminated with this trust. It gives you 100% lawsuit-proof asset protection, and it is 100% compliant with IRS Code 643B, which gives amazing tax reduction. I'm going to show you that in just one second. And it's important to remember that this trust, the beneficial trust, the spendthrift trust, can only receive passive income. I'm going to show you why. I'm going to quote from the tax code, or IRS Code 643, because what happens is that all this money, all this passive income that comes into your trust, is you as the trustee are going to declare it to be an extraordinary dividend, and by doing so, according to the tax code, is not considered income. So I'm going to quote right here. It says, for purposes of this subject and subparts B, C, and D, the term income, when not preceded by the words taxable, distributable net, undistributed net, or gross, means the amount of income of the estate or trust for the taxable year determined under the terms of the governing instrument, that means the trust, and applicable local law. Items of gross income constituting extraordinary dividends, which the fiduciary, that's you, the trustee, acting in good faith, determines to be allocable to corpus under the terms of the governing instrument and applicable local law, shall not be considered income. So that means that you declare that to be an extraordinary dividend, and it just becomes an expense and it zeroes out your tax return. And this has been going on for 70 years. This part of the code has been in the tax code since it was originally passed by Congress. And this trust has been used for 70 years, and using this part of the tax code to give a massive tax reduction for our clients, including myself. So the second part of this is that there are some amazing capital gains tax reductions, actually exclusion. I'm going to read from the same tax code where it says gains from the sale or exchange of capital assets shall be excluded to the extent that such gains are allocated to corpus and are not paid, credited, or required to be distributed to any beneficiary during the taxable year, or paid, permanently set aside, or to be used for the purposes specified in section 642C. So as long as let's say you have a rental property, you have crypto, you have something of value that would normally trigger a capital gains tax event, when you sell it as a trust asset, then it means that as long as the money goes back into the corpus of the trust, your bank account, and it's not required to be distributed to any beneficiary during the taxable year, that means it's excluded. It is not a taxable event. So, what are the requirements for IRS Code 643B compliance? Well, it has to be the correct trust. It has to be non-grantor, irrevocable, complex, and discretionary. The funds have to be allocated to corpus, okay? And it is not required. It cannot be required to distribute. Now, a simple trust is required to distribute to the beneficiaries at the end of the day. This trust is not. I'm going to show you just an example from a 1041 tax return of this trust from 2021. You can see that on line 9, it says total income is $937.80, 937 whatever, 832. But when you get down to the actual taxable income and total tax, it's zero. And why is that? Well, we're going to go over here to the deduction part where it says clearly non-grantor, irrevocable, complex, discretionary spendthrift trust. If you go down to the very end, the last expense deduction, I should say, is an extraordinary dividend allocated to corpus per IRC code or IRS code 643B. All right, so by doing that, it's only deductions. There's nothing left over. It zeroes out, so there's no tax. Okay. So let's talk about comparing how the beneficial spendthrift trust works versus the business trust. The beneficial trust, it has a spendthrift provision. Okay. The business trust has one as well. Now, the beneficial trust only receives passive income. The business trust can take the active business income that you generate from selling a product or a service. The beneficial trust holds all your personal and business assets. You're not holding your assets in a business trust. And the beneficial trust is a recipient of the funds that originally come in as active business income that are converted in that trust to passive income. It receives those monies, and then you declare those to be extraordinary dividends. So it zeroes out to the beneficial trust, as I just described. The business trust is a pass through entity, so it has to zero out. Everything flows down to the business trust, the beneficial trust at the end of the year. So both returns zero out at the end of every tax year. So the business trust can basically operate as your existing company. It performs the same functions as a bank account, as it has accounting. If you have if you're working in concert with your existing company, then the business trust signs a professional services agreement. It invoices the every to your customers and your clients, and the money comes into the business trust, not your existing LLC or S corp. Like I told you before, it operates as a pass through. Income comes in, it makes deductions like you would normally, and the profit is passed down to the beneficial trust, and it will zero out at the end of the year. So how do these two trusts work together? Well, there's two ways you can do it. I mean, if you have a newer business or you have an already established business, if you don't, if you're new, if you have a newer business, you really haven't established your brand or your market share, then there really is no need to have an LLC or an S corp. You can use the business trust to run everything through it, and it generates active business income. Now, if you have an established business like I do, which I have. HB Funding is one of the major short sale companies in the country, and especially it has an A+ rating with the Better Business Bureau since 2004. I want that out there. I want that thing to exist, but I don't want to have any money flowing through it. So what I do is I have my business trust uh, has a professional services agreement with my S corp. Everything is invoiced from the business trust through a professional services agreement, and so the money comes directly into my business trust. And the benefits? Well, by having the business trust and the beneficial trust work together, think about this. Each trust has a spendthrift provision, which gives you 100% um, uh, protection from any lawsuits. So the beneficial spendthrift trust, that's where your assets are held. Okay. Now, if the majority of your money, your income stream is going through your business trust, that also has a spendthrift provision. That means you have locked down your income stream as well. The business trust pays zero taxes because it is a pass-through entity, and the beneficial trust pays zero taxes because of the extraordinary dividend and being in compliance with IRS Code 643B. Let me give you an example. Let's say we have an existing HVAC company. It's been around, and it has a good brand. And so what you do is the owner is going to purchase a beneficial trust and a business trust. The HVAC owner is going to sell their assets to the beneficial trust for a couple of reasons. The biggest one is that now there's no assets for anyone to go after if there is any kind of a lawsuit. They're all protected by the beneficial trust. Now, with running with the business trust, it is going to sign a professional services agreement with the LLC or S corp of the HVAC company, and all of the income is going to flow to the business trust via a professional services agreement. And then whatever's left over after deductions and expenses flows down to the beneficial trust as passive income. It serves as a pass through, and that both trusts zero out at the end of the tax year. If it's a newer company, then the owner might just say, I don't need the LLC or S corp that I have because it really hasn't established a brand yet. You can make the business trust name similar to what you already have, and then you run everything through the business trust. exactly as you would with an LLC or an S corp. The difference is that, again, your income stream is protected with the spendthrift provision. No one can go after it from a lawsuit point of view. And at the end of the year, it zeroes out, it passes down to your beneficial trust. But you might ask me, say, hey, Don, what if my business has a license? If that's the case, then you want to keep it status quo, except, like, for example, medical professionals. Usually they operate through an LLP. But here's the thing, a lot of medical professionals, who have their own practice, they have multiple streams of income. And only the specific medical services that are provided that the medical professional receives income from, then they have to go through, the existing LLP. It can't go through a business trust. So in that case, what you would do is you would still have that income stream going through the LLP, and the business trust can sign a professional services agreement with the LLP. And if it provides some type of service that the LLP is not providing for itself, and that would be as an additional expense for the LLP. LLP is still going to sell its assets, physical and intangible assets, to the trust, and then those are going to be leased back to your LLP, and that's going to also provide as much as 70% reduction in the taxable income of the LLP, and then you can get additional expenses with the professional services agreement from the business trust to the LLP. So you're going to drastically reduce the taxes on the LLP for licensed income. Now, if they sell supplements, they do dietary services or massage, anything that's ancillary that is not specifically licensed medical activity, well, that can all be run through the business trust. And I've already gone through and showed you how that works, on how much money can be, how your income stream can be protected, and how it flows down to the beneficial trust, where it's not going to be considered taxable income. And well, I just ran through this, right? So that's what you do. So you have the leaseback strategy for the LLP. Business trust runs all the non-licensed income streams, and then at the end of the day, your business trust zeroes out. It all flows down to your business trust, where you declare your beneficial trust, where it actually is declared an extraordinary dividend, and it is not going to be a taxable event. So major asset protection from for the income stream and also from the medical professionals' income stream and so forth. So, what are the main benefits of the beneficial and business trust combo? Like I said, you're not just protecting your assets; you are also protecting your income stream. So you get asset protection and you get the income stream protection, and the tax reduction is unbeatable. And you can see it's a very simple process, and you only have one tax return for each trust. So what I want you to do is schedule a free strategy session with me. Just go to my Calendly link. That's calendly.com/Dohn Thornton, which is spelled DOHNTHORNTON/30MIN. That's Dohn Thornton/30 minutes. And I would glad to go over how this can work for you. We can discuss what your unique situation is, and we'll definitely find you a solution to get you that asset protection and amazing legal tax reduction. I want to thank you for listening to this presentation, and I look forward to talking to you soon. Thank you.